Good morning, everyone. My name is Febi Beauty Inda, with student ID number 244-12032. I am an active student in the third semester at Universitas Teknokrat Indonesia, Faculty of Economics and Business, majoring in accounting. In this presentation, I will discuss accounts receivable, one of the most essential topics in managerial financial accounting. This material will explain the meaning, recognition, and importance of accounts receivable in maintaining a company's financial stability and cash flow management. Accounts receivable is one of the most important components of a company's current assets. In business practice, not all transactions are made in cash. Companies often allow customers to pay at a later date. This practice creates what is known as accounts receivable, which represents the company's right to collect payment from customers for goods or services sold on credit. In simple terms, accounts receivable can be defined as the amount of money that a company is entitled to receive from another party, usually a customer, as a result of credit sales. Receivables are considered an asset because they are expected to bring future economic benefits in the form of cash inflows. According to accounting principles, accounts receivable is the company's claim arising from the sale of goods or services on credit, which is expected to be collected within a certain period. Typically, the collection period ranges from 30 to 90 days, depending on the company's credit policy. In the context of managerial financial accounting, receivables are not only seen as assets but also as a vital instrument in managing working capital and making financial decisions. Effective receivables management can help increase sales while maintaining a stable cash flow. Managing accounts receivable is an essential part of working capital management. The main goal is to balance between increasing sales through credit transactions and minimizing the risk of late payments or uncollectible accounts. Companies must have clear policies regarding to whom credit will be granted, how long the payment period will last, and what procedures should be followed for collections. They must also evaluate the creditworthiness of customers to reduce the risk of bad debts. To maintain the reliability of financial reports, companies usually estimate and record an allowance for doubtful accounts, which represents potential losses from uncollectible receivables. Proper management of accounts receivable is crucial for maintaining a healthy cash flow and financial stability. If the amount of receivables becomes too large or too many customers delay payments, the company may face liquidity problems even though it records high sales. Therefore, effective receivables management requires the establishment of sound credit terms, periodic assessment of customers' payment capabilities, monitoring of accounts aging, and prompt action when receivables begin to show signs of default. For example, if PT Kreatif Solusi Bisnis sells goods worth 50 million Indonesian rupiah to a customer on 30-day credit terms, and the customer pays only 40 million Indonesian rupiah by the due date, the remaining 10 million Indonesian rupiah is still recorded as accounts receivable. If the customer later fails to pay, the company must record the unpaid amount as a bad debt expense. In conclusion, accounts receivable represent one of the most significant current assets that reflect the level of trust between the company and its customers. In managerial financial accounting, receivables must be carefully managed to maintain a balance between sales growth and cash flow stability. Effective management of accounts receivable not only protects the company's liquidity, but also supports long-term operational sustainability and profitability. That concludes my presentation on accounts receivable. Through this discussion, we can understand that receivables are not just a record of credit sales, but also an important part of financial management that affects liquidity, profitability, and overall business performance. Thank you for your attention.